It's a good question. I think diversification has potentially never been more important than it is today. We've seen such a concentration of performance, particularly in the US, particularly in the Mag 7s, and investors who are passively allowing themselves to have their weightings driven by market indices are getting more and more concentrated. So for example, the MSC ACWI has over 60% of its allocation is to the US market. In the developed market, MSCI developed market is now well over 70%. So you may think, oh, I've got this developed market index, I'm nicely diversified. Actually, you're not. And why is that a problem? If you think about the MSCI Europe in 2008, it actually fell 43% in that single year. The really frustrating thing is if you started with 100, that means you're left with 57 at the end of the year. But to get back to 100, you had to be up 76%. So diversification is really important to stop you having those big holes that you're going to have to dig yourself out of. And I think it's never been more important probably than now with the massive concentration we've seen, particularly in the US market. I think multi-strategy funds are particularly suited to helping diversification because of the inherent diversification they have in their own right. So to give the example of our fund, the Trium Multi-Strategy UCITS Fund, we have 9 underlying portfolio managers who each are themselves uncorrelated to markets, uncorrelated to equities and to bonds. So that in itself is a good building block to help ensure diversification. But what is the real beauty of it is that they all have a very low cross-correlation to each other. So that means that the aggregate risk is even more diversified. So probably on average, I'd estimate that the volatility of all of those underlying sleeves averages around 6%. But by bringing them all together rather than investing separately, 6%, our average correlation is now our average volatility is about 2.9%. So it's the volatility is halved from 6 to 3, and that is at the same time as us applying allocation leverage of about 1.7 times. So an investor could give us 10 million euros. We actually invest 17 amongst the underlying portfolio managers in this co-mingled multi-strategy fund. So you've got 70% more exposure, but only 50% of the risk because of the inherent benefits of low cross-correlation. And that, by the way, clearly helps dramatically improve the diversification benefits of the strategy. Being in UCITS wrapper has certain important advantages. To my mind, it helps democratize hedge fund investing or this form of investing, which is to get really good risk-adjusted returns in a way that is uncorrelated to markets. And if you go back 20, 30 years, it was the preserve of the joke was that hedge fund investors are predominantly rich people and dead rich people. So in other words, high net worths and endowments. And kind of what about the mass affluent? What about the regular savers? Why shouldn't they also be able to benefit from this method of investing? And so really the benefit of UCITS is it becomes a form of investing that now more regular affluent people can aspire to, can achieve. So that's a very big positive. And we feel that it's a perfect wrapper for wealth managers, for averagely high net worth people, and even for institutions as well who want the daily liquidity and the benefit of the regulatory umbrella. On the downside, I would say it makes our job a lot harder because we have to fit in very thoughtfully in that regulatory umbrella. Though we have some small annoying aspects where we're not allowed to invest in commodities, for example. There's certain leverage limits we have to stay within. As it happens, we feel it makes a very marginal impact on the total return, but it does take the total return probably down a little bit compared to if we were less constrained. So that the other thing we have to be very cognizant of is that we offer daily liquidity. So we're very uncompromising on making sure that the underlying instruments that the 9 portfolio managers are investing in have aggregate very strong liquidity characteristics. So our independent risk team does regular analysis to make sure that the liquidity profile is such that we could happily meet very large redemptions. And right now, I think we can sell 94% or maybe even 96% of the portfolio in one trading day using only 20% of average daily trading volume. The risk team also look at what if we're running 5 times as much money, and again the number's well above 90%, which makes us very comfortable that we absolutely can comply with making sure that we have the ability to meet that daily liquidity requirement. So yeah, in balance, I think we welcome the UCITS wrap. It's hard, but it does make it available to a much wider range of European investors, and we feel it's great that they can have this opportunity to diversify by being able to invest in it.